Hey D&D fam. I'm Quick.
And I'm Lee, and you're listening to
Divas and Ducats. So what is a diva? I think divas get a bad rep. But to me, diva is all about the attitude.
As for ducats, it's your finances, your assets, Skrilla, guap, your coin. We're talking all things with the potential to affect your pockets.
And while we're attorneys by trade, we are divas by choice. Divas and Ducats is for edutainment purposes.
Y'all, we are not Series 511 or 703 professionals. This does not create a financial advisor or attorney-client relationship. The views expressed here are solely our opinions and the opinions of our guests.
It's just our opinion, y'all. Okay, divas, let's talk ducats.
All right, welcome back, D&D fam.
Yes, welcome back to the Divas and Ducats podcast. If you have been keeping up with us, you know we just completed a dating potential 3-part series.
Yes.
And that last one has gotten
people all in their feelings.
A flood of comments and inboxes. And we've been trying to keep up and post them on our stories, but Yes, so if you are watching us on YouTube, go ahead and scroll down below and watch the Dating Potential series, part 3s, 1, 2, and 3.
Yes.
And make sure that you subscribe below if you're watching us on YouTube.
Yes.
And
And regardless of your opinions, hopefully you got something from it, a different perspective, a different way of looking at things. We are going to move forward. As we all know, tax season is upon us, stimulus check season, if you want to call it a thing. And so we thought before that deadline hit, for those of you who file on time, let's talk to a tax professional. No shade, I'm just saying. They're due on the 15th.
Right.
So we brought in a certified, tax specialist because I still call my mama to know what I'm supposed to put for my what's the little selection where they ask you to put are there exemptions?
There are.
Like you put 0, 1, 2. I still have to call my mama, so clearly I don't know the things.
Your allowances.
Yes, that's what they are. And I'll be like,
I don't know.
So we brought in Mr. Tony Proctor. Say hello to the people.
What's going on, everyone? What's going on?
All right. And like they do at church, I'm going to read over his bio. And the next voice you will hear is that of Mr. Tony Proctor. All right. Tony Proctor is an experienced enrolled agent and esteemed professional. In addition to teaching a myriad of businesses and professionals how to navigate the tax code in order to maximize business success, he excels in guiding his clients in the planning and preparation process. With over 20 years of experience in business and IT in both the government and corporate sectors, Tony is proficient at managing processes and developing strong client relationships. He's the founder and president of Proctor and Associates Incorporated, a tax, accounting, and payroll services company with offices in Charlotte and Mooresville, North Carolina. In 2003, he started Proctor and Associates under the guise of helping individuals, especially those in minority communities, learn about, manage, and improve their financial health. Through tax law courses and business finance management classes, Tony gives individuals the tools needed to become financially literate and empowered to better manage their personal assets or business capital. So, after this episode, hopefully you won't be like me and you'll know what to put in your allowance.
And know to call them allowances, right? Let's get into this taxes. Can we write this off? Tell the people hello, Tony.
Absolutely. You can write off everything. That's what I want me to say, right?
That's exact. And teach us how, yes.
Right.
Episode over.
I definitely appreciate the invite here. And I love to talk about this stuff and talk about it with energy. Because obviously you get to talking about tax, people are like, whatever, I'm out of here. So hopefully I can bring some energy and information to the listeners and make it do what it do.
We appreciate you. We appreciate you. So we're going to start this off with the quote from Albert Einstein, right? The hardest thing to understand is the income tax. Okay.
I agree.
Yes, clearly, even from the simple things like what allowances to choose. So can you tell us how you got into tax?
So I kind of fell into it, honestly. So I've always been a numbers nerd.
Okay.
And I guess now that I'm older and mature, it's I guess I can be okay and cool with being a nerd. Obviously, some 20 or 30 years ago, a nerd was not the cool
Right, that's not
thing.
the thing, right?
But yeah, I've always just been a numbers person. Math has always been my thing. Always was helping to tutor my colleagues and all that. And so, it really came to a head when I was in undergrad at Xavier, New Orleans, shout out HBCU. And I was actually driving limos. That's another one of when I retire from this industry, I'm probably going to get like 3 limos and make it do what it do. Okay. But I had someone who sowed a seed into me and bought my laptop and got my first software because I was just doing it on the side. So he said, if I buy you a laptop and get you professional software, would you make a business out of it? And I was like, yeah, dang, skip it. And so I did it. But I did it just, again, mostly friends and family. And it really wasn't until, early mid 2000s where I really jumped into it and started doing like professional tax prep for folks that I didn't even know. So that's really how it came about, honestly, just because I've always been good with numbers and it was cool to do it for friends and family. And then I was like, okay, instead of charging my friends and family $25, let me make it do what it do.
And make it a business.
Yes.
That's how I got into it.
That's awesome.
So when it comes to income brackets, so Quick actually just recently told me, or she learned that all of your income isn't taxed at the same bracket within the same rate. So like, how does that happen? And how can we identify the best parts not to get hit? Because I don't understand.
All right.
So there's a couple different taxes per se. We have income tax, which is tiered, and there's actually like 7 different brackets, and it changes based on your filing status and where your income falls. We also have capital gains taxes. So the folks that are touching in the investment realm, you have capital gains, which is there's 2 options. There actually is 3, 0, but 15, and then 20%. And then there's a lot of people's favorite tax, which is self-employment tax.
Okay.
So my folks that are doing their side hustle or full-time entrepreneurship, and that's set up as either a sole member LLC or a sole proprietor, it's the self-employment tax, which is 15%. And that's the one that creeps up on folks. They're not ready for it, and they kind of bust their head open a little bit. But really, if you play your cards right, your income is going to be your income. Whatever you earn, that's going to be income tax. Whatever bracket you fall into, your taxable income is there. That's the bracket that you end up in. Capital gain, though, we can kind of control that.
Okay.
And that's with the investment. Now, my folks are just hit a lick with the whole GameStop and AMC and all that was going on a little bit back. They're gonna be mad next year when they realize that they made a whole lot of money in a small period of time and didn't pay a dime of tax on it. So as the good Bishop TD said, get ready, get ready, get ready, because it's gonna come around. So it's really being strategic and controlling where you are and helping to manage where your taxable income falls. And that's where a lot of the self-employment stuff comes in, and folks being able to bring their taxable income down.
Okay. And I just wanted to follow up because you said a lot of times the self-employed, they're not, I guess maybe they're not prepared or something that they don't do, and they, and in your words, get bust over the head. So what is that? What is it that they maybe neglect to do or should be thinking about for those who are entrepreneurs? So
keeping track of expenses, and that's, we can do 4 hours on talking about expenses. We ain't got all that tonight. But, number one is keeping track of the business expenses and even taking a step back from that. If you are doing self-employment, making sure that you have a separate bank account for the business from personal.
Yes.
Because a lot of times people will just put it all up in the pot and their whole thing is, well, I made it so I can spend it. But when you start commingling, that's where you now have to start bringing the attorney in, maybe because some things can get a little funky. So having a separate bank account, and then also having some type of financial management system. So no one has sponsored this, but maybe they will one day into it. So our firm does QuickBooks Online. And so whether you do QuickBooks Online, you do an Excel spreadsheet, Google Sheets, whatever the case may be, have a system. Have a system so you can keep track of what your income is and what your expenses are. And the goal is we all get into business, for-profit business, to make money.
Right.
But of course, we want to try to limit how much of that is going to be taxable. So having a system, having a separate bank account, and just keeping track of what expenses you have that are for the business.
Okay. And that makes sense.
Yeah.
So let's really talk about this hot topic that recently people have either gotten it or it's coming to them. That stimulus come up.
Got that stimmy.
Many people, to varying degrees depending on your income, got a nice little check or direct deposit based on the relief package that came down. And so I guess what I want to dispel and even learn about is that free money, or is that being taxed? How is that, or how does that work?
So, not to get all nerdy, but essentially the stimulus payments are an advance on a tax credit that's going to appear on the tax return. So the payments that were received back in April of 20 and then earlier this year, January, February timeframe, those were advance payments on a tax credit that appears on the 2020 return. And so it is not taxable income. Thank you. I'm glad for that. But it does need to be reported on the return. So if you were due to get the most recent one was $1,400, but I'm gonna take it back even to the $600 earlier this year. If you were due to get $600 and you got it, then we had to put on there that you got the $600. But if you didn't get the $600 for whatever reason it may be, we do want to make note on there that I did not receive my stimulus, so that you can get it as part of the return. So it's not taxable income. A lot of people are like, I don't put that on there because I don't want to be taxed on it. But it's not taxable. It's actually an advance on a credit that's on there. So
so it reduces the credit.
So yes, so you would be due, again, we just use that 600 one. You would be due to get the $600 credit. You 600 early.
Gotcha.
But we need to report that we got it. And if you didn't, then run me my money and let me get it now on the return.
Gotcha.
That makes sense. And so, as she was saying, like, some people were surprised that they received the stimmy, because they thought they may have not been eligible based upon income. What were the income stipulations, and are they also different based upon how you file? Head of household, single?
So we had single, and then we have married. So you basically, once you hit the 75,000 threshold, it started to fade out. That was the first two, the one early 2020 and then early 21. This most recent one actually was 75, and then it had a clip at 40. If you were a dollar over that, it was a wrap. And then for married, you actually basically it's doubled up to 150, and I want to say the clip is like 160, 165. It's slipping my mind right now. But it was a hard cliff. Like once you hit it, it was no start coming down. It was just like done, zero. So again, trying to be strategic, because some people have played with their returns to try to get a certain number. Which has its advantages sometimes, but it could have disadvantages as well.
Right.
And that was based upon the 2020 filing or the 2019 filing? Is it?
So both.
So
it's I had a joke in our staff meeting earlier this week that I feel like IRS just took a bag of 27 million marbles, threw them up in the air, and wherever they landed, either they would pick the 19 or the 20 return, and those were the folks that ended up in this first batch that hit in March.
I believe it is. Will not incriminate myself, but I believe that's what happened.
Okay, that's good.
Thank you.
So, and I've heard a lot of times, just speaking of, stimulus, around that time that if you filed taxes, you might be getting just your regular refund or what have you. So what I've heard that is if you get a refund, it means that you paid too much throughout the year. Is that true, or I guess is that the right perspective to kind of look at it through?
So, one of my favorite answers as an accounting professional, and probably the same answer for my attorney colleagues, is it depends.
Yes,
because there are a number of things that go into getting a refund. You could have refundable credits, which are going to boost your refund. You could have non-refundable credits, which just go up against the liability. Again, not to get all nerdy with it, but it could also be your money. So if we just take, for example, a $5,000 liability, if you've had $7,000 in withholdings from your job, then you're going to end up with a $2,000 refund. So it's money that you have let them hold on to for a year, and now you're getting it back. But then some of my folks who are getting like these $6,000, $7,000, $8,000, $9,000, $10,000 refunds, they probably didn't make the same amount of money to be able to get that type of withholding, but they have what's called earned income credit or additional child tax credit if they got 2, 3, 4 children running around the crib or what have you. And so when you come into those are refundable credits. And so if you only had $500 withheld, but then that credit ends up being $3,500, that's not your money. That's a refundable credit. And so now you end up with a larger refund. So it really depends. I mean, it's all over the place. We get some clients who are only doing $50,000 a year, and they may end up with a $10,000 refund. I got some clients who are clocking $1 million, $1.5 million, and they're getting $60,000, $70,000 refunds. If you made 1.5 and you had $380,000 in withholdings, a $60,000 refund. I mean, whatever. So
it's
that is their money.
It's nothing to sneeze at.
You got somebody's salary as a tax refund, and I'm like, I need you to stop doing that because that's not fun.
Right. So just speaking of just like refunds and make it the whole liability, because I think it feels better at least to be owed money than to owe. And so one of the things that, previously I've done contracts, or maybe like entrepreneurs might not be in this place where they can actually, do W-2s for folks. They might 1099 them or have them basically as independent contractors. So is there a best practice or things that those type of individuals can do to ensure they're not owing a bunch of money come tax filing time? Is there a way to like file throughout the year, or like how does that work?
So throughout the year, you'll be doing what's called estimated tax payments.
Okay.
And so those estimated tax payments are going to be based on what you anticipate your total tax liability to be. Now, there's a couple of ways that you can do that. If it's like a side hustle type of situation and you have a full-time gig and I probably need to have an additional $5,000 in withholdings, you can actually transfer that burden to your employer and have them to take more out of your check. Now, people say, I hate that because now my take-home pay is going to be less.
Right.
But if my take-home pay is $1,000 less because they're paying this $1,000 to the feds or to the state for me, but I still got my side hustle money sitting in the bank. So, you're being strategic with it. The other option is, leave your take-home pay as it is, and then make sure that you make these quarterly payments. And the whole point of the quarterly payment, people make a big deal out of it, rightly so. But the whole game is to make sure that at the end of the year, you don't end up with a liability that exceeds $1,000. Because if you end up with a liability that exceeds $1,000, then you get hit with an estimated tax penalty because you didn't pay enough into the system early enough. So again, those quarterly payments are going to be at the end of every quarter. So you got April, July, you got October, you got January.
Yeah.
So put the burden on yourself to make those 4 quarterly payments, or just make sure you have an additional amount taken from your job. And I'd say let them be responsible for sending the money so that you can just do what you do on your side hustle.
Yeah. Okay.
That's fair enough. So we have had discussions before. I don't necessarily know about, I don't like saying hiding money, but
it's not hiding. Okay. It's repositioning.
Yes. Repositioning your funds. So is there a way to, if you have a, entrepreneur and you have a business, to pay your child? Why you laugh?
Because you're over there caressing their body.
I hear that question all the time, and I love it. Yes, you can pay your child, and you can pay your child up to $12,000 and some change per year. Now, if you're on whatever they call it out there, LLC Twitter, people have these memes out there like, pay your kid $12,000 and save, but there's so many more variables that go into the mix. And again, that's probably I've done hour-long seminars on that, so I ain't gonna sit here and bore you guys with it. But in a nutshell, number one, you have to have a business.
Okay.
So you can't just be like, I make $120,000 at my job, and I'm gonna pay my kid $12 to save. So you got to have a business.
Fair.
You have to have a business that has profit, because you can't take a $20,000 loss on your business and then say, I paid my kid $12,000. So you got to have enough that would justify paying the kid, and your child has to be treated just like any other employee. And they have to be paid a reasonable salary. So you cannot pay your 9-year-old child $87 an hour to Staple. Come on now. I mean, that ain't gonna fly. Right. But behind the scenes, what's happening is that the 12,000. The reason that number is so key is that the standard deduction is 12,000, and it's like this year is 12,600. But we're just gonna go with 12,000. So $12,000. The first $12,000 of your income is going to be exempt from tax. So that's why, as a kid, if the only thing that they made is $12,000. Is exempt from tax, and we're good. Now, that's on the federal side. We also have to deal with the state. So depending on where you are, you have to make sure that you are aware of what's going to happen from the state side. I'm in North Carolina, and so we have a $10,000 deduction for just single taxpayers. So you still got about $2,000. Again, all in, you're going to end up paying maybe $100, $120. But for $12,000 tax free, I'll go ahead and run that 120. But there's so many more pieces into it. I'm not gonna get too deep into the weeds, but the big one is you got to have a business, usually on a Schedule C, self-employed. You have to have profit on that business, and you got to treat them just like any other employee. So clocking
is there an age limit?
Description, all that.
Is there an age limit with the child?
There is not an age limit, but it's essentially, I would say probably 18 and younger.
Okay.
Because once we get over that, they may be working elsewhere, but no, you can't pay your 37-year-old son who's still in the house. Okay, never mind. That's a whole different show. Okay.
Can I pay my 5-year-old?
You can. Look.
Okay.
You can pay your 5-year-old, but is your 5-year-old doing $12,000 worth of work?
I mean, they doing artwork for the.
That's a lot of landscaping. The baby can barely hold the rake. Barely hold that rake.
So I mean, you can pay up to 12, but I mean, even if it's 5,000 or 6,000, I mean, that's still helping you out.
Yeah, right. Yeah, for sure.
It's not like an all or nothing. It's not like I have to pay them the full 12.
Right.
You can pay them 6 or 7 and still get benefit from.
I mean, that's good to know though, because I did not know that going into this conversation that it wasn't. I just figured you got to figure out a way to get this 12,000 popping. So
gotcha.
To know that it's just the max is 12 or 12.6, then I mean that's helpful.
Yeah,
so
it is for sure.
Woo. So we want to get into these LLCs.
Do we? Yes.
I mean,
LLC is fun. Come on, let's go.
Yeah, listen, the joke is attorney. We didn't go to school for the numbers. Okay, we're the opposite. When 2 + 2 stops being 4, and you got letters and stuff, it's too much. So, LLCs, as Tony said, limited liability companies. We won't bore you in terms of the varying semantics around business entities. I will say I'm not a fan of sole proprietorships. I'm just gonna put that out there. But because you're liability. Now, I guess my question is, as LLCs, when you have business partners, right? And so you're sharing expenses, you're both doing things for the business. Can they're filing separately as, they're two individuals. How does that work with maybe itemizing the expenses they paid towards that business? Or do they have to file one collective filing for the business? Does that make sense?
Absolutely.
Okay.
So it really goes back to, hopefully there's been a conversation with the attorney, because if there are multiple members in the LLC, and we're just going to talk about LLC, if it's a multi-member LLC, by default, that is a partnership for tax purposes. Okay, cool, whatever partnership. What does that mean to me? A partnership, multi-member LLC, now has its own separate partnership return. And people probably going to hate me when they're now listening to this, because if you have a multi-member LLC, you also have a partnership tax return due date of March 15th, not April 15th. And a lot of people get it twisted. I had some calls already this week that are like, oh my God, I'm going crazy. And yeah, unfortunately, you were not properly advised on what you were getting yourself into, because Google is not approved by the board. Okay, never mind. Anyway, so multi-member LLC, which means that all of the activity gets reported on that partnership return.
Okay.
So we made $100,000 in revenue. We spent $50,000 in expenses. We got a net profit of $50K. And if we're 50-50 owner, then you get $25,000, I get $25,000. But that's going to be reported on what's called a Schedule K1. Again, I'm gonna do my best not to get too nerdy, but that Schedule K1 is just like a W-2 or any other form, but that's how it comes over to the personal return. So I can't say as partner A, well, this is what I paid, so I'm gonna go and take this off of mine. It needs to be coming out of the business.
Okay.
Now there's a little bit more to it, and I would definitely say seek legal counsel and seek accounting counsel on the proper handling of it. But, kind of at that high level, you have a partner return. And let me just talk about this partnership return real quick. 3/15 is the deadline. On 3/16, your return is late, unless you filed an extension, gives you 6 months, whatever. It is $205. I don't know why they did $205, but they did $205 per partner per month late fee. So March 16th, you got 3 people in your partnership. You got a $615 late fee.
Goodness.
Yes.
Each month.
And so imagine what happens when you haven't done it for a couple years.
Oh. That's what we got going on?
That's what we got going on. And so, if there are multiple people in this LLC, you have a return that's due on March 15th, or at this point was due on March 15th. And you better take action real quick, because they're gonna hit you in the head with them penalties.
So, and with the March 15th filing, do you just so let's say the person may not want to file their individual taxes for whatever reason till April. Do you just file the partnership filing and then you could just save it for your individual later? Is that how that works?
Yeah. So the partnership just has that deadline.
Okay.
Now, each individual partner, you're going to get that Schedule K1, and that if you file your return on at the same time or at whatever the case may be, but you cannot file your personal return before that partnership is done, because we have to report the activity that happened on the partnership. So again, a lot of people they'll file their personal return on February 9th because they're trying to hurry up and get their refund. But you got a whole partnership that needs to be done. So it makes the situation even more muddy, because now we have to amend your personal return and blah, 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 blah. And every time there's more just like with the attorneys, every time there's an additional job that has to happen, there's another invoice that needs to be sent out.
Right. More ducats.
And more ducats.
So that brought me to it, and just to follow, and I this might be a silly question to a tax professional, but I'm like, So you were saying back with the $12,000, entrepreneur pay your child, you were saying that one of the requirements was that you have to be profitable. And so I always wonder, like, businesses, I think the average for a business to be in the black is like 3 to 5 years. So if you're operating at a loss, like you're not making money, do you have to file business taxes?
Yes, you do.
Oh.
Absolutely. Even if you did not make $1, that you still need to file a return that says, hey, we didn't do anything, or we made $100 but we spent $500. We still have to file that. And they don't don't, like, those $200 $205 penalty, they don't care whether you made $1 or 10 million. You're going to end up with the same thing. So you have to make sure that you file it, whether or not you made $1 or you lost, or whatever the case may be. And then kind of touching on that 3 to 5 years, that's kind of, it's out there, and people say, well, if you don't make money within 3 years, they're going to shut you down. That's not the case. As long as you are in pursuit of a profit, if you are in pursuit of a profit and carrying your business in that way, you can take a loss. I mean, the reality is, if I made $50,000 in year 1, year 2, I should be maybe making 75. Year 3, I should be making 100. And if my expenses happen to exceed my income, that's fine. But there should be some type of forward progression. But if you make 50,000 year 1 and then make 52,000 in year 2, and then you make 26,000, it's like, are you really in business, or are you just playing around out here? And that's where it gets muddy. So as long as you're in pursuit of a profit, if you happen to be taking a loss, then, and you can show it, obviously you got to have the receipts for it. Then
show me the receipts. That was a good question.
I mean, I just thought about it because, as he said, Twitter LLC, and I just was thinking, like, there's a lot of businesses out here that I don't think they have EINs.
Yeah.
So I was like, well, do they have to file if they just kind of started on, you just on social media, but you're not really, you're not balling like your client who got a $60,000 refund.
Yeah, well, when you know better, do better. So he told us here. You heard it on Divas and Ducats. You got to file. So let's get into some of the fun stuff, right? So, of course, with the wide sweeping of people making a lot of money and through entrepreneurship, through social media, like they're able to use vacations. They go on a vacation and they're selling clothes. They're able to, take photos and sell clothes and write that vacation off because it's a business expense, podcasting and all the things.
Right.
What are like some of those stipulations of what doesn't qualify?
Yeah.
For being able to write taxes off for vacations.
Yeah. So I get this all the time and I love it. As long as you can prove the business component, then you're good. Now, here's the reality. Before COVID, or after COVID, if we got to take a trip to
Greece,
the Caribbean, and we got to fly there, we got to fly back. So my travel is going to be 100%. I got to get there. I got to get back. I can't control that.
Correct.
Now, let's say we go to a convention for 3 days. The convention is 3 days. I end up hanging out there for 7 days. So those 3 days from my hotel, my Airbnb, my VR, wherever it is that you're living for that week, the 3 days that's there for the conference, I can write off those 3 days 100%. The remaining 4 days, can't do anything with it unless I go out here and I start having some conversations about the business. Now I got to be able to prove this. Like, if you sell tires, then what you going down to the Caribbean? Let's make it. We got to be real with this thing.
You're trying to open a Jamaican branch.
For my boutique sellers, if you're going down there and you're trying to get your dresses in a couple of shops, then let's make it do what it do. And here's what I'm starting to tell people nowadays, because when the feds or state are starting to do audits, they're going to social media because all your business is on social media.
This is true.
So I'm finna check in at this boutique, having a conversation with Tyrone, thinking about putting putting these dresses in the shop. Y'all stay tuned.
There you go. There you go.
Now when you go and you look at my social media, oh, okay, I see you was there. Okay,
right. That's where she talked to Tyrone.
Got it.
So, make sure that you have proof that there was a conversation about business. And I tell people it's 2021. Mm-hmm. So whatever paperwork you got to print out, what have you, write on it and digitize it. Take a picture of it, scan it, whatever the case may be, because that carries so much more weight when you did it in the moment versus 2 years later when the feds come knocking on the door and you trying to throw an Excel spreadsheet together real quick and trying to gather stuff. The weight is carried because you were carrying yourself properly when you were on that trip. So that's the way to do it. Make sure that you talk about business and prove it. You got to make sure that you got proof that makes sense.
Put it on paper.
Put it on paper.
Okay, so that's one thing I know in the legal field. So people who are in private practice have to hold their records for a certain number of years, and I think it might vary state to state. So in terms of what you're saying with, having things like that together in case you ever are audited, like what is a good number to kind of hold on to that stuff?
So I usually say 4 years.
Okay.
If you are doing what you're supposed to do with your taxes, then and you filing on time, then typically they're only going to go back 3 years. So I say 4 just in case something happened. We got a little cushion in there. So 3 years is typically when they're going to go and look back, unless you've been out here riding dirty. And so if they drop the F-bomb and they think that there's something fraudulent going on.
Oh, that one. Okay.
The limits are gone, and so they can go back as far as they want.
Right.
And you better be able to prove it. So, if you're doing something that's kind of walking the line a little bit, I would say hold on to yourself a little bit. But if you're doing what you're supposed to do, your filings are good, 4 years, you'll be straight.
Gotcha.
Cool.
Okay. Good to know. Rule of 4.
Right. So since we in this write it off situation, how is it that the Trumps
of the world,
Yeah.
How they get away like gabillions?
What did they say? $750. I just want to get close to the mic. $750. Like people making $50,000 might get that taken out of bi-weekly check.
Of a bi-weekly. How
so
they do it?
I just want to know.
Help us.
Someone offended.
Yeah. So here's the deal with Trump, and here's the deal with what the media did to kind of splice. And I'm a bit of a nerd because I've got all the presidents and VPs tax returns except his. And the minute that his get released, I'm gonna be all up on them.
Oh, you really?
Right.
So earlier we were talking about the different types of taxes, and so his income tax was indeed $750 something. But here's the thing. He has been spending money like nobody's business for years. And so he's got what's called, again, I know I might get a little nerdy, he's got net operating loss. And so because he's had these losses for so many years and they've been carrying forward, he might make a couple billion, but if he's still got $7 billion in stuff that he spent and it's carrying forward, it's eating up his income. But then also, he's got all these businesses all over the place. So he is paying a buttload in payroll taxes.
Okay.
And so because he's employing all these people, the amount that his businesses across the board are contributing from a payroll standpoint really kind of help to balance out what he isn't paying in income tax. But I tell people, if you want to go to Trump tax plan, then you have to have lost about 150, 200, 400 million. So if you can manage to lose 400 million and bring that forward, then we're good. But that's how that's happening.
Okay.
And to be clear,
I'm waiting for that return to be released. I hope that my sister up in New York get him to force his hand to put those returns public, because I'm all up in.
Right.
Yeah, because I'm just like, what part of the code is that? Because I would like to highlight. I just want to know, because in my mind, I'm like, how is he not broke then? Like, where's the money? I'm just.
Yeah. Is it in real estate? What are they doing? Like, where do they put it in?
Yeah, the payroll tax, and that's why a lot of big businesses, when they get all these incentives to come to town, it's because they're going to employ people. And a lot of times you hear the news or it'll say, well, our favorite company, Amazon, then built a new distribution center, and they're going to be hiring another 417 people with an average salary of $70,000. Like, that's part of the agreement behind the doors. To say, well, what's your average salary going to be? Okay, about 70. All right, so $70,000 in the average salary. We're getting payroll tax off. Those folks are going to come into town. They're going to buy houses. We're going to get real estate taxes. They making $70,000. They're now going to shop at the expensive grocery stores. So I mean, it's business.
Yeah.
So we don't care about the income tax. We want to get all these employees payroll tax, real estate tax, and sales taxes.
Yeah.
That's how that works.
Okay, makes sense.
I haven't studied this stuff. I promise.
So the only thing I have, and I always let quick finish on a note because sometimes it kind of pops up with it. But the only other one I wanted was really open-ended for you. Like, are there any other nuggets or maybe little known factoids or things people can take advantage of that as you're preparing or doing tax filings, you notice people aren't taking advantage of?
So one of the things, again, is systems. I cannot push that enough. I get so many people that just show up and, I guess their accounting is on my ceiling tiles, because I'll ask them, well, how much did you spend in advertising? About 700. And I'm like, for real? Or my favorite ones are, well, it's the same as last year. Okay. But your income doubled. Where your system? Like, I need to see a profit and loss report.
Right.
For having that system, some of the things that a lot of people miss out on are these subscriptions. Everything is on an auto pay nowadays, and so you're paying. Again, I'll pick on QuickBooks. You're paying your QuickBooks subscription. You're paying for some advertisers. I mean, you're paying so many subscriptions, and you put them on auto pay on a credit card, and you don't even realize that those monies are coming out. And it ain't nothing. It's only $120, but by the end of the year, that's almost $1,500.
Right.
In one subscription.
In one subscription.
Right.
And so you've missed out on that because you don't have a system to keep track of it. The other thing people won't like me on this is making sure that we account for all the income. Which, when it's time to do your tax, you don't want to account for all the income because you don't want to pay tax on it. But then when it's time to buy a house, buy a car, or get financing, and you sit up here tomorrow, oh yeah, my business does about $250, but on paper it's got $13. Are you gonna drink on that, Lee?
I'm just saying, you're gonna
Cheers to that.
That's gonna be a quaint house. I don't know what you're gonna get.
And then the other one is mileage. Folks, I think there's such a misnomer or misunderstanding rather on mileage. Either we can take the mileage or we can take our actual expenses, but we have to keep track of what the mileage is. And so whether you use an app, you using an Excel spreadsheet, you're doing something, that the mileage usually messes people up because you're not doing it the right way unless you got an app that's following you everywhere you go and you got to swipe left or right or what have you. But people just, again, they pull the numbers off the ceiling tiles. They just look up and they be like, about 6,000. I'm like, but you drove here, 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 and here. Oh yeah. Well, add another 100 on it.
That sounds about right.
It does. It's so us.
All right. So I mean, I think, again, from the self-employed side, those are the things. And the final one, of course, is retirement contributions. I can't push that because if you're self-employed, you don't have a major company that's going to contribute on your behalf. And so you out here grinding and you grinding for 10, 15, 20 years, and then you're ready to hang it up and you don't have anything sitting to the side to help you to live your life. So now we got to go to Walmart and start checking receipts when people exit the building because we don't have anything saved up for us. So, I don't care if you only put $1,000 in that thing for the year, it's something. Yeah. Put something in there. I'm all for the tax benefits of it, but dang, I want to have some money when I'm ready to retire for good. So
put something on it.
Right. And to that point, is there, and you may have said it, is there a specific type of account that's, let's say, a 401k for entrepreneurs?
Mm-hmm.
So there's a bunch of accounts out there. And I usually tell people, have a conversation with your financial advisor. But let's have a meeting with the advisor, because there's some things that will help you from the financial advisor side that are going to hurt you on the tax side.
Yeah.
And so we want to make sure that we kind of have that holistic approach where we make sure that whatever it is that the financial advisor is recommending is going to be beneficial from the tax side. But usually it's going to be like a SEP IRA or a simple, or some type of solo 401k.
Okay.
But just get something,
Yes.
put something in that thing.
Yeah.
Yes. And I'm here for that communal conversation about these coins. So, you have anything else?
No.
All right. Well, we want to thank you for being with us, and we would like you, if you feel comfortable, shout your social media out or contact information for the people so they can reach you. Make sure their taxes are straight.
That's right. So phone number 704-385-1040.
I see what you did there.
I see what you did.
Love it.
Social media on IG, Proctor Tax CLT, on Facebook, Proctor Tax. And one other thing, I'm sorry, this just hit me. For the record, the tax returns have been extended. So it's not 4/15. It's actually going to be May 17th.
Okay.
And so May 17th for Fed, and most of the states are following suit on that. So definitely be aware of that. And then again, all these things are starting to come to me right now. Unemployment. So a lot of people had to take unemployment last year. And so with the most recent plan that Uncle Joe signed for us, we can exclude up to $10,200 of unemployment from taxation, because unemployment is taxable income. A lot of people don't realize that, and a lot of people are going to get hemmed up when they don't put that unemployment income on their return. But we can exempt up to $10,200 of it from federal tax. And depending on what state you're in, some states aren't. They're not playing. They not following suit, and
they like, run me my money.
They want that money back. So just be aware of making sure that we account for that unemployment compensation, because it is indeed taxable.
All right. Look at Proctor with the quick tips.
Okay. That part. And of course, we will have his information below and in our show notes for those that are listening via podcast.
All right, you all. That wraps this week's episode, and we will see you all again in a couple weeks. In the meantime, in between time, you can follow us. We are Divas and Ducats on Instagram and Facebook, www.divasandducats.com, and on YouTube, as you know, because you're watching. So, in the meantime, in between time,
have a great attitude.
All right, bye.